If I told you you could pay no taxes on your Social Security, would you have an interest? It's actually kind of a loaded question, and in this video, I'm going to share with you 6 simple strategies so that you can reduce the impact of taxes on your Social Security so you can get close to, as possible, paying the least amount that you have to. But before we get there, subscribe to our channel. I have over 30 years of experience in this business. I want to share with you the insights that I have, the conversations I have with my clients, so you can benefit from those as well. So I said right off the bat, it's kind of a loaded question. Do you want to pay no taxes whatsoever? Well, if I give you the difference in 2 different scenarios, if you have $30,000 of income versus, let's call it $300,000 of income, which would you prefer? My guess is that you'd rather have the $300,000 than the $30,000, though on the $30,000 you may pay no taxes on Social Security. So again, we have to put this conversation into a bit of perspective. It's not so much paying taxes, it's keeping as much as we can. So I want to share with you those simple strategies as we move forward here. So the first simple strategy is move. What do I mean by that? Seems kind of odd, doesn't it? But if you were thinking about potentially moving from your residence now to some place that may be better off for you, physically, health-wise, activity-wise, whatever, you may want to take a look at the 38 states that on a state level, they do not tax your Social Security. So if that's important to you and you are considering moving to some other locale or region, you may want to check out the list of states that do not tax Social Security at their state level. So I want to share with you the tax table so you understand and can put into proper context what you may have to pay with regards to your Social Security. So let me take you to my screen. So the important concept to understand with regards to Social Security and whether or not your benefits are going to be taxable is called the provisional income. And that's your adjusted gross income plus half of your Social Security benefit plus tax-exempt interest, which is typically municipal bond income. So the tables are that if you're married and filing jointly and your provisional income is over $44,000, which is where most of my clients are, then up to 85% of your Social Security benefit will be subject to tax. If you're single and it's over $34,000 for your provisional income, then upwards of 85% of your Social Security is going to be subject to tax. So why is this important to understand? Well, I'll share with you a story. And it goes back a number of years ago, and a client of mine called me up. She was in her early 60s. She had not yet reached her full retirement age. And she was going to be generating some part-time income. And she said, listen, I want to take the grandkids to Disney, and I need $8,000 more in terms of income to do this. Is it okay if I do? So I got in touch with her accountant, and we took a look at her numbers. And the particular thresholds that she hit, it was like the perfect storm. She just maxed up and bumped over thresholds on both Social Security and income, and was going to get taxed. And Social Security was going to be withheld because she was going to be earning money and collecting Social Security before full retirement age. You can take a look at my video to understand more about that. And for her, it meant an effective tax margin on the $8,000 of about 78%. Or in other words, she was only going to keep 22% of the $15,000 or rounded off to about $1,600. So we basically went back to her and said, it doesn't make any sense. The hours that you're going to spend working, you're not going to net out the right amount. So these are some of the calculations and maybe the impact if you don't understand the thresholds in terms of what you're looking to do now that you're collecting Social Security. Now, the next really simple strategy is if you're looking to lower or eliminate the impact of taxes on your Social Security is just wait till a later age. Now, if you're born between 1943 and 1954, your full retirement age is 66. If you're born in 1960 or later, your full retirement age is 67. And then they prorated in between. I'm 1955. So my full retirement age is 66 and 2 months. Well, I can defer all the way up to the age of 70. And depending upon my circumstance, if I do and I'm interested in lowering the tax on my Social Security, then maybe I move it out 2, 3, or 4 years. It's really a double benefit here. I'll get delayed credits for taking it later, so I'll get more later, and I'll defer not having to pay taxes on it for the 2, 3, or 4 years that I'm not collecting. The next strategy is you could Roth it. Now, this does take into account more than likely a bit of advanced planning. You should probably be taking a look at this probably no later than in your 50s, because when you get up into your 60s, depending upon how much in the way of assets you have or what your circumstance is, it may not be worth it to convert money from a traditional 401k or IRA into your Roth, because typically, depending upon the circumstance, when you do go to make that conversion, there's an upfront cost, and it may not make sense. So you have to touch base with your advisors as to whether or not you're going to do this. But I'll tell you why it's important to take a look at some advanced planning on this. So the Roth is the ability, just like the IRA or the 401k, to have money in it, have it grow tax deferred. But there's two benefits to this. One, there is no required minimum distribution, which is kind of nice, particularly if you don't need the money starting at age 72. But from a tax perspective and Social Security, it comes out tax-free. So you could get your $10,000, $20,000, $50,000 a year coming into you. It doesn't show up as earned income. It doesn't impact your threshold for Social Security, reduces the tax on the income coming out of the Roth versus what you would have gotten from the IRA. So you may want to take a look at Rothing it when you're in your 50s. The next one is the HSA, or the Health Savings Account, which is often when you're working for an organization, you can put in, typically for medical purposes, into an account that will actually grow tax deferred if you haven't used the money, and it can accumulate. And when it does accumulate, it too comes out tax-free with no impact on taxes on that income. So again, unlike a flexible spending account, the HSA may be very beneficial if you are eligible for one. Now, the final strategy is what I'll call marrying gains and losses. Now, this gets into real planning here with your accountant, with your financial advisor. And here's the deal. So if you have capital gains that are coming through, whether you own mutual funds or whether you bought or sold stocks and you made some money, then you're more than likely going to have to pay either short or long-term capital gains on that. But if you anticipate before the end of the year and take a look to see if you have any either carryover losses from previous tax returns, or you can find an investment that hasn't done well. We've all got one of them, right? And it's in the red. You may want to consider selling that to marry up the loss with the gain to eliminate the tax or minimize the tax on that. and in essence reducing the amount of income that you show, which would also potentially decrease the amount of tax on your Social Security benefit. This again is something you should be talking about with your advisors. And when it comes, we had mentioned speaking about 401ks, take a look at our video to learn more about some of the mistakes you should avoid.